Good afternoon. My name is Kim Schoenholtz. I'm delighted to welcome you to today's webinar on the LIBOR transition. The host of today's program is the Stern Center for Global Economy and Business, which serves NYU through outreach to the broader community, including the academic, business, and policy worlds. Thank you very much for joining us for today's webinar. We'll begin with introductory remarks of up to 10 minutes by each of the panelists, followed by audience Q&A. We'll finish by 6:15 p.m. For the Q&A portion, please enter your questions through the Q&A mechanism in Zoom. Since we have already received many questions from students and faculty, I will limit repetition by grouping similar questions together. Please note that anonymous questions are not permitted. Let me now briefly introduce our distinguished panelists. David Bowman joined the Federal Reserve as an economist in 1993 and is now Senior Associate Director in Monetary Affairs. Dr. Bowman is the board's senior liaison to the Alternative Reference Rates Committee, the group of private market participants convened by the Fed to help guide the transition from LIBOR in the United States. He has contributed to landmark reports of the Financial Stability Board on reforming interest rate benchmarks. Dr. Bowman received his PhD in economics from the University of California at Berkeley. Kathryn Judge is the Harvey J. Goldschmidt Professor at Columbia Law School and is an expert on financial markets, financial regulation, and regulatory architecture. Prior to Columbia, Professor Judge clerked for Judge Richard Posner of the Seventh Circuit and for Justice Stephen Breyer of the Supreme Court. She received her JD with distinction from Stanford Law School. Professor Judge co-chaired the working group on the LIBOR transition of the Financial Research Advisory Council of the Office of Financial Research. She's an editor of the Journal of Financial Regulation. And finally, Tom Wipf chairs the Alternative Reference Rates Committee that is guiding the U.S. LIBOR transition. Tom also is Vice Chair of Institutional Securities at Morgan Stanley, where he has worked for over 3 decades, helping to fund and hedge the firm's activities. He is a member of Morgan Stanley's Securities Operating Committee, the Risk Management Committee, and the Asset Liability Management Committee. He also chairs the CFTC's Interest Rate Benchmark Reform Subcommittee and serves on the board of ISDA, the International Swaps and Derivatives Association. Please join me in welcoming our distinguished panelists. And now, Tom will begin the presentations, followed by Kate and David in that order. After their brief initial remarks, we'll start the Q&A session. Tom, all to you.
Thanks, Kim. So just to start things off, we really want to level set in terms of where we are in this transition. So from the beginning of this work, way back in 2012 through 14, and the establishment of the Alternative Reference Rate Committee to determine a replacement for US dollar LIBOR, there's been an enormous amount of work that's led us to this point. We are working under the assumption that LIBOR will sunset at the end of 2021, and that people in the market should be prepared for that transition as we approach it. Over the first several years of work, the Alternative Reference Rate Committee spent a lot of time building tools for the market to ensure a smooth transition, whether that be better legal fallbacks for products, whether that be just guidance in terms of how market participants could transition forward. But as we've begun to approach the end, and what I think has been referred to by President Williams of the New York Fed as entering the end game, with now only 452 days to go until the end of LIBOR, we are now reaching a point where actions speak louder than words. We've moved quickly from the theoretical to the practical, and market participants now are approaching this deadline. And what's really taken place, I would say, over the last several years, but really coalescing around the middle of this year, had been a pretty straightforward guidance that we have received from the official sector. So policymakers, supervisors, and others globally are now speaking collectively around this topic to take people forward to ensure that this transition is smooth, its impacts are minimized to the best extent possible, and certainly as this rate impacts many market participants, consumers included, and really the dealing with the fact that, LIBOR, dollar LIBOR is referenced in over $200 trillion in financial contracts, while the underlying transactions that support those rates are less than $1 billion. So where we are right now is, as we approach the end game, heading towards the end of 2021, we have heard clearly from the official sector the work that needs to be done. We have approached this with the fact that even during the COVID environment, the ARC has been able to complete its milestones and deliver on its on the things that we've set forth to do, and to provide the market with the appropriate tools. Many of those including best practices for market participants, specific dates that would make for a better sequencing of events for market participants, but really to ensure the smooth transition. So between the official sector, clarity towards this deadline, which we've heard from the Fed, the Bank of England, other central banks around the world, along with the FCA in the UK, who is the regulator for LIBOR, that there's a clarity of message. Also, ISDA has produced a series of protocols and fallbacks for the derivatives market. So they've completed their work along those same timelines. And in the US, the Alternative Reference Rate Committee, as I mentioned, has also delivered against all their milestones up to this point. So now we're really moving to the points of action. And what we see as we approach this 2021 deadline is that there are things on the near-term horizon that will become more market impactful. And one of the clear incentives and motivations for people in the market is, what are the economic eventualities and outcomes that we're looking at right now? When will they happen? And what are the catalysts that we will see that will sort of combine all these things? And that is all beginning to intersect around year-end 2020. So we've really sort of, taken off from providing the tools, doing the work, assessing the problem, delivering on a replacement rate for LIBOR, which is the secured overnight financing rate or the U.S. Treasury repo rate, providing methods and alternatives for how market participants can utilize those rates, and really getting to the end of what we call the ARC, the PACE transition plan, or the idea for market participants to begin using the new rate, SOFR, and beginning to roll down their LIBOR exposures on a legacy basis and on a go-forward basis to move more using SOFR for all new products, which at that point we, as we say, we stop digging the hole and we begin to focus on our legacy issues, but we know that new issue and new production will happen using these new risk-free reference rates, which are based on large numbers of transactions. SOFR has over $1 trillion in daily volumes that support that rate. So with all that behind us, we are now approaching, I think, the key points in this, which is several events on the horizon that will begin to, I think, inform market participants that these are impactful. Those are things that are happening at the clearinghouses for derivatives in terms of switching those rates from Fed funds to SOFR, the implementation of the ISDA protocol, which is a way that market participants can address their legacy derivatives books, and several other factors as we move through time. But when we get into the last year of this, we will already have probably seen significant market impacting events as we approach that. So I guess I would just leave this with the idea is that we have entered the end game. There's a lot of work to do, and there are near-term horizon events that we think are going to be very, very impactful as we move through time. So with that, I'll pause and I'll pass the call to Kathryn Judge.
All right. Well, thank you for having me. I want to thank Tom and David for all of their hard work. I think Tom did a beautiful job kind of describing where we are, the world broadly speaking, in this transition away from LIBOR. And if it wasn't clear, this is the ultimate marathon and not a sprint. I mean, we are incredibly better positioned probably than I actually would have guessed that we would have been if a year ago you had told me that we were going to have a massive pandemic hit and create significant distractions over what was already a Herculean effort. And it really is, I think, thanks to the hard work of Tom, of David, Tom's predecessor, Sandy. I mean, it has taken us years and a lot of effort by a lot of people in the public and private sector to get to where we are. But we also have a very, very long way to go. And that is the interesting challenge that we're facing right now. I think we are as well set up as we could be under the circumstances. But as Tom alluded to, SOFR, these risk-free reference rate, they operate differently than IBORs like LIBOR. It was a necessary change. It was a change that we had to make, because we wanted these rates actually ones that we could trust because they were based on actual market transactions. And banks had fundamentally changed the way that they finance themselves from the days when LIBOR was originally adopted. Banks are no longer reliant on, unsecured term credit. That's actually a very good thing when it comes to financial stability and bank stability, but it's a bad thing if you're used to relying on an IBOR like LIBOR, because it meant we really needed something not just new, but something different. And when you're going from something that is a different type of rate and requires different types of tools, you're going to have a lot of messiness along the way. So I'm just going to have 3 quick themes that I want to touch on. Unlike Tom and David, who live and breathe this stuff, I'm kind of come in as the outside academic observer. So some outside thoughts. One of the things that's important as we talk about a smooth transition is to understand what we mean by a smooth transition. And it's really critical there to manage expectations. Again, I think SOFR is the right replacement rate for many products, for most products, but it operates differently, and we have a lot of legacy products out there, which means there's going to be hiccups along the way. That is not a sign of a failed transition. That's a sign that it's inherently going to be a messy process. I remember one of my first projects when I was making the jump into academia was looking at the way securitization structures created a bunch of information issues, but also created some unintended rigidities. What the issue there was houses were underwater in a way nobody had anticipated. The rational thing to do to maximize the value of a lot of those underlying mortgages was to renegotiate the terms of the mortgage. But depending on how you did it, if you gave more of a cut on interest rate, if you cut back on the principal, different tranches of the securitizations were going to be affected differently. And the servicers, which are the third parties that are brought in to kind of work with all those homeowners, just did not have the authority or the right incentives to make the changes. We're seeing similar issues here. It's a small example, but it's an important one. Again, you have securitizations, which were built around a time where we thought LIBOR was going to exist forever, so they have really poorly suited fallback language. And you have different tranches, sometimes, of issues that have been issued, and sometimes they're actually directly competitive, right? I mean, you have some that are based on LIBOR and some that are only going to profit if interest rates are really low, and you actually have the last fixed LIBOR at something like what it is right now. They could make a lot of money. So you have these inherent kind of complexities. That's in a financial instrument. We also have it inside of firms. But what happens, what we've seen over and over again, is people put in these arrangements that create some short-term efficiencies that make sense in the moment, but they're not thinking about all of the contingencies that might arise. And so we're going to see some litigation. We're going to see some challenges within firms, within financial instruments, because there's a lot of layering on complexity that had long-term costs that were not adequately thought about ahead of time. And it's just going to arise again. Second, Tom did a nice job of putting on the straight face and saying, one of the things that's been great is that we've had this very consistency of message from all the different regulatory fronts. And I think that's actually largely been true. But we have also seen just what a messy, messy regulatory world we have in the US, and also the incredible ongoing challenges of international coordination. So if you just look at the alphabet soups of regulators that have had to have been involved, it's huge. I mean, so clearly David Bowman's here, New York Fed, very early on, playing a great role, just coordinating the private sector and providing some public sector support. But of course, there's also the Fed there and 2 other bank regulators as bank regulators pushing all the banks to understand their exposure, as we've had to have the CEC, the SEC, the CFTC, both involved in different ways, very meaningful and both quite important, still quite involved. We had FHFA in there very early on with Fannie and Freddie and trying to figure out what's going on with the federal home loan banks. We've had to have the DOJ in there because there's competition issues. As we're trying to figure out what to do with all these legacy contracts, there's a question, do we need the New York State legislature? So just within the US, you have this incredible degree of coordination. But it's also messy because you have to get all of these different bodies up to speed. They all have different degrees of nuance and understanding of what's going on and why it matters. And so it's been a huge issue. I mean, I think we've seen some of the costs of the regulatory fragmentation, just trying to get everybody up to speed. And I think going forward, there's still some challenges for international coordination. I think some people look at it as like we had LIBOR as part of a a period of time where there's this international financial system. And as we move from these London-based risks to all of these reference rate committees across different jurisdictions, that we're actually moving to more domestic control. But the reality is not all dollar-denominated assets are within the jurisdiction of even all of the different US regulators that we just mentioned. So you do have a real challenge of things like legacy assets abroad that are dollar-denominated. And I think right now when we think about these issues, we're thinking about, generally speaking, the Fed with swap lines and the new repo facility trying to provide dollar liquidity abroad. But there's a lot of other complications that arise. I mean, the FCA right now is still considering, my understanding at least, a possibility of a synthetic LIBOR. And they're using their regulatory authority to say, okay, it's only going to be this very narrow subset of tough legacy assets that could use this. But even if they're creating it for that very narrow purpose, you could have parties in the United States or private parties who are seeking opportunistically to try to find something that either resembles LIBOR or for litigation purposes. And now you have a UK regulator that's saying, look, we're creating it for this purpose, but now it can be globbed on by parties in other places. So one of the interesting things to just watch is that we did have a long period of time where there was a technocracy that kind of was the backbone of a lot of the international financial regulation. As there's been a backlash against that, there's been a move towards kind of more domestic control. But as long as you have assets that are denominated in currencies that are not domestic currencies, and also the spillover effects that are huge, we're going to still need to find ways to have bilateral and multilateral coordination. I don't think we've seen any huge hiccups yet, but it's going to be an ongoing challenge, and LIBOR just brings that to the fore. And just the last point I want to make is that even if everything goes as smoothly as it possibly could, which again is going to mean road bumps along the way, it's going to be a long time before we understand the full ramifications of that transition. And it's not, even if we're honoring the end of 2021 as when this actually happens and we manage to move away from LIBOR. So again, just one example, different banks are making different choices, but a lot of banks are moving to SOFR for when they want a variable interest rate. One of the reasons that was a slow transition for a lot of banks to make is they really like that when you have LIBOR or an IBOR, that you get a little cushioning in there for various credit conditions that you might face over the life of a loan. And so they like the fact that when the financial crisis hit or when other hiccups hit in the financial markets, something on their asset side of their balance sheet is showing that because they're getting a little higher rate of return on those outstanding loans. Now they're having to deal with a risk-free rate. And again, I think they had to move to a risk-free rate if we want to have one that's resilient. But that means they have to come up with a new way of modeling kind of what they anticipate the different challenges might be over the life of that loan. And different banks are going to do that differently. And so now they're going to have to add on like a few basis points right at the beginning for the cushion they used to have built in into the IBOR. And you can imagine, without anybody having any malintent, particularly now when borrowers can go online and very quickly understand what interest rates are being offered at different banks, there's going to be a migration towards the banks that are adding fewer basis points at origination, which are going to have the models that are more optimistic, about what, the overall credit cycle is going to look like over the life of that loan. So you could actually imagine more credit creation, more on the balance sheet of the banks that don't necessarily have the best models and might be actually really underestimating kind of the funding and other challenges that they may face over the life of a loan. So I think both thanks to David and Tom and a lot of other people, there's been a lot of progress made, but getting between here and the end of 2021 is going to be a challenge. Dealing with the operational and legal risks and other challenges that are going to continue to arise even in the immediate aftermath are going to be a challenge. And I think there's a possibility of latent risks that we haven't yet seen. So it'll be interesting to watch.
Well, thank you. It's a pleasure to be here. And, this is a really interesting process to go through. In some sense, we've been going through it for 9-10 years. And a lot of this, as Tom said, and I'll try to go through it maybe from a different perspective, has been building infrastructure. When we began to understand how weak a rate LIBOR had become, or maybe always was, there was a lot of thought process that had to go on because, as Kate discussed, people didn't really have very good contracts. They're pretty fuzzy oftentimes, or just wildly inappropriate about what would happen if LIBOR ever just permanently stopped. They were really meant to address what if LIBOR just had a one-day outage, just didn't get published for a day. And there were real financial stability risks around that if you thought, what if LIBOR was going to stop? To the extent that in the beginning, and even to today, when we, probably the first time I ever met Tom, right? We were in a meeting with Jay Powell, and we were talking about, LIBOR could stop. And I'm pretty sure, at most of those meetings, people are going, LIBOR can't stop, You guys are crazy. It's impossible that it could ever stop. It's impossible. So I think there were a lot of meetings like that where it's just like, you can't even conceive of what that would mean for LIBOR to stop. So I do agree, even in the best case scenario, there's going to be operational hiccups. It's not going to be just perfect. I mean, people could actually do that if they wanted to. They could get out of LIBOR before and they would have that kind of nice smooth day, but they don't seem to be doing that. So there will be operational hiccups. And it will be really interesting to see what happens after. And that'll be interesting too. But I think, from my perspective, what's important is that the financial system doesn't collapse. That's my kind of baseline. And, had LIBOR stopped, as it could have, 8 years ago, 5 years ago, I think the financial system would have collapsed because they were in no way prepared for it. They just built this huge, massive, interconnected infrastructure, not really caring what they were building it off of. And that's come back to bite us all. And so, throughout, this has been building the infrastructure to allow the financial system to get through this. First thing that you would do is you say, well, can I fix LIBOR? And we really did try. And LIBOR is, incredibly reformed from, the bad old days of 2008, 2010 or before. As a grad student, I knew derivatives pricing models. I knew that there was this thing called LIBOR. I knew that London banks were doing it. I thought the London banks must be really sophisticated. So I thought, naively, they must be doing something really great. It must be really professional. And then, I get to the Fed and you kind of learn how the real world works and you learn that they're just calling some guy at a bank and saying, what's the rate today? No verification, no nothing. And it was pretty disappointing. It's like, well, that's just crazy. Nobody would do that. But they were. And as has been discussed, the main problem with LIBOR is that banks just don't fund themselves that way anymore. They don't fund themselves wholesale unsecured. Maybe they never really did enough to make LIBOR a robust rate, but for sure they don't now. And you can see it in the data. There's just very few transactions underlying LIBOR. So, what infrastructure? Can you fix LIBOR? Well, we tried. I think that helped. I think that bought us a few years for us to have tried that. But once you kind of figure out, well, that's going to hold it maybe together for a few years, we need to do more. There's a lot of infrastructure that had to be built. You had to assess, is there some other rate that could replace LIBOR that is robust enough to handle $200 trillion of LIBOR, US dollar LIBOR contracts? No. So then you got to build a rate. And then you had to build a group to figure out what that rate would be. So we built the ARC, with Tom being one of the few people who's been along all that entire journey. And then we had to do something pretty crazy, which is we had to build a rate. So the rates that the ARC, the two front runners, when it came time for them to choose, they didn't exist in 2014 or 2015. The Fed had to produce both. And SOFR, I think it's good for the market, but it is the kind of rate that really took a lot of time to build and reflects a really important market to the global financial system, but it just wasn't there it didn't appear by magic. And then after that, you have to figure out, well, how can I get people to move? The ARC is not, despite the fact that I work for the Federal Reserve, I'm not on the supervisory wing of things. It's not in my power, just to tell any bank, you have to use this or you can't use that. And that's not the approach of the ARC. The ARC, everything that they do is voluntary. This is a public-private partnership, and it is voluntary, which means people can look for other rates. They can do whatever they want. So how do you create a focal point to try to get the market to be organized enough they could actually get through this? There can be other rates, but if everybody tries to go in a different direction, they will not have a smooth transition. So you need some way to try to get people to go in the same direction. And so, I think a lot of the focal point in terms of thinking about how you could get the financial system through this was in the derivatives market. 95% of LIBOR exposures are in derivatives. That's gross notional, but gross notional wouldn't matter if LIBOR just stopped because you don't know if you can net. And so, the plan of attack was really through derivatives. Can we get the derivatives market safely through this? That'll produce a focal point. And so approaching ISDA to start a protocol process, because you're going to need a protocol. And approaching the dealers, but also the major clearinghouses to see about how you could create a whole new derivatives market. And that was what became the ARC's PACE transition plan that it's working its way through. So that kind of infrastructure had to be built. And then, how do you tackle the legacy contracts? Because if there were no legacy there are two real challenges. One is legacy contracts, because the contract language didn't envision LIBOR ever stopping. The other is, and it's strange for an economist, but all the operational challenges, even just using a new rate, which in the model, you write it down on paper, it takes you 5 seconds. You just use a new rate. But there are lots of operational challenges in that, and it takes a lot of time to build that. So for legacy contracts, again, how do you fix that? Well, the ISDA protocol is one way for derivatives, but how do you fix that for cash products? You can't. There's no protocol for that. Well, okay, so then we need fallback language. So the ARC does a lot on fallback language. That doesn't address legacy things. So then maybe we should think about approaching the state of New York or US legislation. All of these steps had to be built, and they took a really long time. And I feel like now we're coming at a place, and this month is actually a pretty important month because the ISDA protocol will come out in a couple days, I think. Finally, that took 4 or 5 years of work to get that out. And at the same time, the key step in the ARC's PACE transition plan, which is a move at LCH and CME to SOFR discounting, will happen in 10 days. So 2 really big steps will happen. And I guess the way that I look at it, someone told me this analogy last week, it's like building a very large building. For a long time, all you see is a really big hole, and it doesn't look like a lot is happening. But in fact, a lot is. You just can't see it because you don't build buildings. It looks like a big hole. I think now we're at the stage where the actual building could go up quickly. We've tried to build this infrastructure to allow people to transition through this if they choose to do that. So I think the ARC, and through Tom's work, through the official sector's work, we've given people tools now, but they have to build that actual building. Otherwise, and they can do that, but if they choose not to, then they're just going to be sitting in a really big hole when 2021 comes around. So that's still the trick. Will people do that? And LIBOR is still the dominant reference rate, despite the fact that the official sector's warned over and over again. Not that it will stop, but people need to prepare for the risk that it could stop as soon as the end of next year. People are still using it in almost all their transactions. And so there does need to be that shift in mindset where they finally begin to move away from it. And we've given them tools. In terms of operational challenges. There'll be a lot of operational challenges, even if you're prepared and New York is working through that. How do you have a security that says LIBOR, but now it's SOFR? How does the custodian know that? Who tells them what the rate is? Who tells them what the new conventions are? All that kind of stuff is things that we're working about. And, in terms of what happens after, banks will have to learn how to use SOFR. Borrowers will have to learn how to use SOFR, and it's a good reason for them to start now. Everything you said, did the banks like a rate that went up? Sure, a lender always likes the rate that goes up. The borrowers aren't as nearly enthusiastic about a rate that goes up in times of economic stress. And so there's, people will need to calibrate that, and banks definitely will need to know how to price it. I'm not as worried as you might be. It might seem like, if someone just takes more risk and therefore offers a lower spread, they will win the market. But I think a lot of the larger non-financial corporates have learned from the last financial crisis, from March and April this year, that just because someone has what seems like a good deal in terms of a lending agreement with you, what counts most is that they'll actually have the money when you want it. And so they've done a lot of work to be careful to choose their lenders carefully, assessing the lender's creditworthiness, at least as much as the lender is assessing the borrower's creditworthiness. So I guess I'm hoping that the non-financial corporates, will continue that. And then I'm fairly confident we won't have a race to the bottom, but we do have a lot of learning to do. And with that, let me stop.
Thank you all. That was a wonderful way to get started. And I want to add to Kate's expression of gratitude to Tom and David. The work that you guys have done is just extraordinary. And that everyone in ARC and the among key regulators like the Fed and the Federal Reserve Bank of New York as well is really an amazing contribution. I think it's fair to say that this transition from LIBOR is one of the largest reforms of the financial architecture that anyone has ever tried to undertake globally. And the fact that we're this far along is really quite remarkable, even if we're not quite there, and there's still a lot of things to do. So I'm going to focus my questions on what's still left to do and what's probably going to happen over the next year. And so I'm going to just start, I'd like to start with Kate, if you don't mind. Michael Held, the general counsel of the New York Fed, a year and a half ago, was talking about the cessation of LIBOR and suggested that it could be a DEFCON 1 litigation event. And I'm wondering if you might be able to fill people in on what those risks were that he was concerned about, but also ask, have we made enough progress that we're now at least at DEFCON 2 or 3 or 4, or maybe off the national security list?
It's hard to conjecture exactly where we're at because you would need insight into a lot of things that nobody has full insight into. And that's just one of the really interesting challenges here. I think, so first of all, we have made huge progress. As was already noted, in addition to coming up with SOFR and publishing, a number of different rates that work for different purposes by compounding in arrears, one of the really great steps that ARC took was to come up with fallback language specific to all of the different types of contracts that relied on LIBOR. And one of the things that became clear during that process is a lot of different types of agreements are using LIBOR, but because the process of amending those agreements and the purposes that they serve vary, you actually don't want uniform fallback language across all of the different pool of instruments that are actually referencing LIBOR, which in and of itself is telling us something, right? Like that is in and of itself a sign that just because you're using LIBOR doesn't mean you are all after the same thing, and that doesn't mean that you have the same flexibility. And so the very heterogeneity that we've seen, and it is, meaningful to an extent across those different types of instruments, I think tells us something about some of the challenges that might arise with the legacy contracts as we go forward. A related point, and again, I think we have made meaningful progress. I think there has been a lot of good faith effort to make meaningful progress. Following up on David's point, notionally, the swaps are where it's at, And thanks to the ISDA protocol, there is a much, much, much better mechanism in place to effectively amend all of those contracts than there is with a lot of contracts that involve much smaller dollar amounts, but also less sophisticated parties, or that have mechanisms for trying to amend them that are just much more complicated and much more difficult. So I mean, the good news is, we're not through the ISDA protocol yet. It has yet to be widely adopted, but everything is moving forward to make that happen. But there's a lot of little pockets and corners here, and we're not going to have full visibility into all those different domains. And finally, the question actually reminds me of something that you nicely made a point of. So I'd worked with Kim on this OFR working group, and one of Kim's point is, as a practical matter, if you're going to do this, you really want parties to amend as far out in advance as possible, because that way they're not going to actually know who's the winner or loser from the original contract language relative to what you're going through as a replacement. So it's a classic idea that you're going to be much more likely to try to come up with a fair solution if you don't have the ability to opportunistically game, well, last stated LIBOR is going to be this in this particular interest rate environment. We no longer have that luxury. I mean, we are not only in a place where the end of LIBOR is, more in sight, but let's be honest, we all know where interest rates are going to be at, the 450 some days that Tom knows it is until LIBOR ends. So that sets the stage, I think, for some opportunistic behavior. And I think we have to expect that there's going to be at least some litigation. How much is going to depend, does the New York legislature come through or not, and other factors. But again, that's a little of it is not a sign of a failed system. It's how great and how much uncertainty does that create that's going to be the bigger challenges.
Thank you, Kate. David, you pointed out that we still see an overwhelming number of transactions that are referencing LIBOR, euro-dollar derivatives, for example, relative to SOFR derivatives. But you also mentioned some very important events that are taking place this month. For example, the ISDA protocols that have been worked on by people like Tom for years, and the change in discounting at the major clearinghouses, LCH and CME, which will introduce SOFR discounting. Do you expect that we're going to have a wave of, just an enormous wave of transition from LIBOR to SOFR that will take place in a matter of weeks or months before the end of the year because of these events in October?
I think both of those will increase momentum. The move to SOFR discounting will give broker-dealers real SOFR risk that they need to hedge. Not so important for end users, but for them, it is something that they hedge and will want to hedge. And so it gives, and was always meant to give, a real foothold for SOFR liquidity. So I think that it will help. I don't think it'll be overnight that suddenly we'll see a jump. In part because we've already seen some of the impacts. We've seen the SOFR curve liquefy more. It still needs to liquefy further, but it has liquefied more further out as people begin to try to prepare for what's coming on October 16th. So we've already seen some of the impacts of that. So it helps to push, and I think helps to cement. The ISDA protocol has a key financial stability component. That success of the ISDA protocol is really, at the end of the day, what defines if we're in a DEFCON 5 or DEFCON 1 or past DEFCON. That first and foremost is the intent of it. But it also makes clearer to people that what they're calling LIBOR is really SOFR. When you're trading a 10-year or 20-year LIBOR swap, in my mind, it's a couple years of LIBOR and it's mostly SOFR at this stage. And so it begins to erase some of that kind of fiction that people have in their minds, that there is this thing like LIBOR that actually means something in swap land. And then once the spread is set, once there is an announcement about what's happening to LIBOR, then I think that too will be a catalyst. So the initial protocol, I think, will be a stage in which a lot of banks will really, for the first time, be having more serious conversations with their customers. Are you going to sign this? By the way, notice you're still using LIBOR over here. By the way, I'm going to need to move my discounting with you on bilateral, uncollateralized trades to this. So a lot of other discussions will happen. But then also, once the spread is set, whenever that announcement will come, I think then we will begin to see more rapid movement out of LIBOR towards SOFR. I don't know how much, but the ISDA protocol will not be perfect. You're not going to get a standard SOFR swap. You're going to get a slightly unstandard SOFR swap, and at some point, not relying on the protocol, not needing to worry about the operational challenges of actually making it through that day, but closing out before reestablishing a SOFR position instead and having a much nicer day. When LIBOR stops, I assume, will begin to be more and more attractive. So there are always going to be inflection points. I think we still have some more to come. Unfortunately, as much as I love it, I don't think everyone's going to be out of LIBOR before LIBOR stops, but I think they will try to get some of that way, certainly in derivatives markets.
Just to follow up, what are the other tipping points that you think might be relevant over the next 6 to 12 months?
Well, the ARC has put out best practice recommendations, which Tom and company really worked hard on. And those, again, they're not supervisory, but I think they have some impact. Because people don't want to necessarily be out of line with if someone says something's the best practice, they will generally try to want to follow it. So that will create some too. SOFR's actually already over the past 6 months, there's been more SOFR issuance than LIBOR issuance in the floating rate debt market, which is a success. A lot of that has come from the FHLBs, who are very large floating rate debt issuers. But we've seen success there. The ARC's best practice recommendation is no more LIBOR floating rate debt, at least long-term LIBOR floating rate debt, after the end of this year. I think you might see some non-financial corporate issuers who they issue short, but they're still issuing LIBOR. They may, maybe not exactly on the day, but they may try to align themselves with those. We have best practice recommendation about no new long-dated LIBOR loans, June of next year, and that too will be an inflection point. So the ISDA protocol, whenever the announcement comes about what will happen to LIBOR and those spreads are set, I think will be an inflection point. Our best practice dates will be an inflection point. And liquidity, it is, it's endogenous, right? It's sticky. When something's liquid, it's very hard to move away from it. Even if you tell people it's going to stop, they just can't help themselves. They have to use it. But once enough of the momentum moves in the other direction, then we will use that, as part of to help the transition. Once SOFR liquidity will beget more SOFR liquidity, and SOFR use will beget more SOFR use.
Great, thank you, Tom. I know that as head of the ARC, you're probably talking to more people than anyone about this project, an incredibly broad universe of people, including folks in the financial sector, folks, non-financial firms that are thinking about how it affects them. When you talk to folks, what are you hearing as the questions today compared to what you heard a year ago or 2 years ago? How has the discussion shifted?
I think the discussion has evolved considerably, and I think one of the key dates was certainly back in July of 2017 when Andrew Bailey made his announcement that he had agreed that the panel banks who submit to LIBOR had agreed to stay on until the end of 2021. And that really, at least was the beginnings of a real deadline. And, and when we go product by product, it's not that there's a transition, but every organization has their own transition depending on the products that they're in and so forth. So when we do events like this and we speak to large groups of market participants, everyone has their own set of challenges. And certainly in dialogue that we have here with clients, whether that be with insurance companies or pension funds, money managers, everyone has their own variety of challenges around this. But as we've moved through time, these conversations have become much more about actions that will be taken, as opposed to 2 years ago, we would have had the same conversation where the theoretical would have been, is this really going to happen? There's no way LIBOR can go away. As David mentioned earlier, this idea that there was this whole sense of disbelief around the fact that this could happen. That I'd have to say that's 90+% out of the system, and people are really now focusing on what they need to do with their organizations, risk prioritizing things, and beginning to think about it. And when we have these conversations, what we find is that there's a lot more discussions about how organizations have put governance around this, what structure they put in place. But it doesn't mean that we're, even if we get this down to a real 80-20 problem, it doesn't mean that when LIBOR goes away, I think as David mentioned, there may be people in the market who at some point, because they're just not that active or not that engaged, may not find out what this is until the next coupon comes up on their loan or their note. So, we're taking this as far as we can. Large organizations, I think, are well organized. More and more people who have reliance on LIBOR are there. But as we get deeper into the system, market participants who may or may not have a lot of LIBOR exposure, or may not realize that a lot of LIBOR exposure exists within their own firms, across entities and jurisdictions where we have all these agreements among different parts of our organization. So I think that we've moved very far along the curve from where we were 2 years ago. People are focused on execution. What are the challenges they have? What tools are available? And I think, as Kate mentioned earlier, what are the things that are just very, very challenging or maybe impossible to repair?
So I really liked your 80-20 analogy. That's probably true for any kind of transition. Maybe if you get lucky, it's 90-10, but you're still left with that hardcore. And I wonder if a large part of that hardcore might be consumers, in the sense that they don't frequently undertake financial transactions. They're not paying close attention to such arcane developments as the replacement of LIBOR. If they wake up on some day in 2022 and find that their cost of their mortgage, their adjustable rate mortgage, has gone up, is that going to be a source of political concern for people trying to make sure this transition is smooth?
I think from the ARC's perspective, the one thing that was made very clear from all the guidance and what we've discussed is that consumer products require the highest standard of care. And from the beginning, I think the mortgage market in the U.S., you can see that there have been major steps taken, on how to actually address fallbacks at the end of LIBOR, but more importantly, with the leadership of the FHFA and the GSEs and the home loan banks, the idea that there will be an end to LIBOR production of this year, that there will be floating rate mortgages that can use SOFR. These have all been created. Those tools are there, and that's really, in terms of sequencing, why that particular work stream was out in front of almost anything else. We understand institutional players are going to have a different set of challenges, but certainly I'd say in the mortgage market in the U.S., floating rate mortgages, there's a clear path forward that's got consistency among the GSEs, their regulator, the home loan banks, and others. So that's a key piece. On the other part, this is really where banks have discretion. This really comes down to disclosures and education and dialogue up front, because what we have heard from many community banks and others is that very difficult explaining SOFR to a consumer who may not understand what LIBOR is. And so that whole educational process will get there. But I would look back and say we did at some point, and I don't know how we did get from prime to LIBOR without a lot of breakage. So I'm assuming that as long as there's good communication, good change, but none of this is going to be without some legal risk, as we know.
Great.
Yeah, I would jump on that. I mean, there are going to be lawsuits absent legislation, and there may be lawsuits even with legislation. But the ARC has taken a lot of work on consumer products. And this is part of the point, right? I mean, some of this is, I'll go to different events. It's like, well, SOFR is not, it wasn't designed for banks, and that's a bad thing. But that was the point of the ARC, right? It's not a pro-bank group. It's supposed to be in the middle. And they've spent a lot of time with consumer advocacy groups. Consumer advocacy groups have been, integral to the entire process in determining fallback language and conventions. And the ARC spread adjustment is tailored for consumer products, so they won't see a jump. So they've done a lot. And again, this is all about incentives, right? If you have a good process, then you incentivize people to use the recommendation because they are scared about getting sued, especially for consumer products. So the ARC's best defense here is to run the cleanest process that it can possibly do. And that's how you try to attract people to use the ARC solution, because there's safety in numbers, there's safety in a well-run process.
Great. By the way, just to make sure it's clear, the range of fallback language that the ARC has introduced is extraordinary across a whole wide range of products. And you need, if anybody wants to know about it, you need to go to the ARC website. It's all available there. So I encourage people to do that. That actually leads me to my next question. There are probably many people in the audience who would like to be able to track developments in the transition going forward over the next 12 to 15 months. They can go to the ARC website, but is there a simple dashboard where you can actually look and see, here's milestone A, B, C, these have all been completed. And by the way, here's the degree of liquidity in SOFR contracts and futures. Here's the degree of liquidity. Here's the availability of term SOFR, et cetera, et cetera. Is there one place everybody can go to find all that information?
Well, I think you just mentioned 20 things, or about 20 things. So that's hard. We're actually, one of my pet projects has been trying to get the ARC website to be a little bit more user-friendly, because the pace of, there's so many publications that you just can't find stuff. And then in terms of liquidity, I think we could definitely do that. I find in terms of derivatives for futures, at least, CME is a very good page where you can find their futures activity. And they tabulate Bloomberg floating rate debt issuance. You can find that pretty fast. Claris sometimes has nice little dashboards on SOFR liquidity, but there's so many facets of it that there's not a one-stop shop. Is it futures, or is it swaps, or is it basis swaps? But we're trying to make the ARC website more readable so you can find things more quickly there.
Great. Did anybody else want to jump in on that? Or is anybody creating a website that I'm not aware of?
It's hard. There's like 70 different ARC publications. Probably it's hard. How do you
I have a colleague who's asked specifically about being able to find SOFR swap rates. So questions about that. Those are the kinds of questions that I think that are out there.
Actually, I have a quick follow-up on that. I think part of the challenge, something like that should be findable. And I'm sure they'll eventually get the ARC website, which I actually think is good. There's just so much there. One of the challenges is that even though we have David and Tom here, and they seem to be kind of at the center of this complex regime, it's also a really decentralized process, right? So they're busy educating a bunch of regulators, they're busy educating market participants, but as Tom said, all the different firms have their own mechanisms for trying to deal with this. Those look very different. And as he talked about with banks trying to educate consumers, there's similarly banks trying to educate their non-financial clients. And so there's a bunch of mechanisms. We see consulting firms coming in, we're seeing law firms coming in. So there's a bunch of mechanisms through which information flows, but it is not a centralized top-down process. There's been a little bit of that with some nice coordination among the 3 different bank regulators, but there's a lot of decentralized mechanisms through which information is flowing, which is part of the reason we don't have just a neat system in place where we can say, okay, so legacy contracts of this type, how many of them are there? How far along are we? There's not that structure in place because of the structure of the market that's affected by this.
Great. So I certainly don't. I'm certainly not going to mourn the cessation of LIBOR, but I do. But one of the questions that's come in is, what do we lose when we replace LIBOR, which gave the appearance of being sort of a one-stop shop, with a whole range of benchmarks around the world in different currencies, some of which might be safe rates like SOFR, some of which aren't. What are the costs of that kind of transition to a very different way of operating?
So there are costs. You have to build the new infrastructure. I'm fairly confident that say 5 years from now, once you're used to it, you won't remember. I am continually puzzled. It's a weird system that has been built off of LIBOR, I will say. But it is super convenient, and on paper it makes like tons of sense, even though in reality it doesn't. So, the multi-currency loan, a bank will quote you, or a syndicate will quote you, well, it's LIBOR plus 50. Well, is that for dollar LIBOR or sterling LIBOR? They don't care. Their story is, that's their funding cost in each currency, and they're sticking by it. Now, I know, and anyone would know, that that's not their funding cost, right? I mean, a U.S. bank maybe can get LIBOR plus 50 here, but they can't go off and get Euro LIBOR plus 50. Maybe Eurobank could do that, but they can't. But they have this nice fiction of, right? It's just our funding costs in all these different currencies, and it's not their funding cost in any of them. But on paper, it sounded great, right? It was very easy for a loan desk then, or a cross-currency basis swap to do that. And that is something that's going away. Now, I mean, in my mind, because it was never their funding cost, to begin with, it doesn't seem that sad to me. But they're definitely, they have a sense of loss about that for sure. So it is more complicated in that way. You can do it, the cross-currency basis swap. I hear this a lot. Well, SOFR is a repo rate, so that's secured. SONIA, the equivalent in sterling is unsecured rate. So how can the world live with this? But the truth is, these are overnight rates. So the amount of risk, credit risk in either a secured or unsecured rate is de minimis. The Fed funds rate, in theory, has credit risk, but it's overnight. It just follows the Fed target. So these rates, they just follow policy rates. That's basically what they are to do. One can be a little bit noisier than the other, but you average that out. And so, the real risk is the currency risk. So a lot of these things are just people getting used to new basis. They face basis all the time, but it's basis they're used to. Now they say, oh, there's a new basis that seems scary. Once they get used to it, mathematically, it's not any bigger than the basis that they deal with every day of their lives as financial institutions.
Great. We've had a good bit of volatility in the repo market over the last year, and some periods in which even the Treasury market looked like it was going to get disrupted in the midst of COVID. How is that affecting people's perception of SOFR as a reliable benchmark?
I think the first headlines around that were a bit challenging, and I think that it was really just a series of educational steps that had to take place. And initially, it was very clear that if you have a rate that's not based on really transactions, then it's not market based. Then the repo market is a market. So ultimately, it was just really having people understand from the point of why did the repo rate go up, which was about policy implementation. Why, does the Fed impact SOFR? The Fed, the monetary policy is employed through the Fed funds rate. So, and SOFR has a relationship to Fed funds, obviously. But it was really getting people through all of that in 24 hours was the challenge. And that was really where I think that the communications that came from the ARC really laid that out. And in fact, during that period, the changes between SOFR on an average basis were 2 basis points and LIBOR was 4. So when we really looked at it all and we unpacked it, but the idea is you're talking about really the repo market obviously is extremely technical to begin with. So getting people to understand the repo market, how the Fed implements monetary policy, why the spike occurred, what it means, certainly wasn't the best day for the SOFR marketing department. But at the end of it, if you really looked at it, the fact remains, it's a market rate, and that was the market. And I think people have now really gotten past that. And obviously, most market participants are going to use this on an averaging, not a daily basis anyway. So I think it required a lot of explanation about a lot of particular topics that seemed to just all converge on back in September.
Go ahead, David.
I mean, that was something the ARC always knew that, if you choose an overnight rate, there's going to be a day like that. They didn't know when. But even if you look at Fed funds, there's a day in I don't know, in 2004 or maybe 1996, I forget the date, but it went up 800 basis points. I have no clue, how or why the rate can do that. But if you understand these markets, you know that it's going to happen sometime. It just happened to happen in September or March. From the ARC's perspective, again, as Tom said, derivatives markets know how to do overnight rates. I mean, they're based off averages, and life is fine. And that's really the kind of communication. People get confused about that, right? They see the overnight SOFR. They don't really understand that that's not really the coupon they're going to get, the coupon's going to get, or the interest payment's going to be based off, compound or simple average. And so that kind of education takes a long time.
Can I jump in on this really quickly as well?
Go right ahead, Kate.
Perspective? I mean, I agree with everything that's been said and I saw those rates go out and you're like, oh, this is going to be hard for SOFR. But I think one of the other lessons, so first of all, as was already alluded to, if you're using actual transactions, you're going to have days that are like that. And what we want are actual transactions. We're going to have days that are like that. But if you actually look at the full, everything that's happened over the last year, the time in March, but also the time last fall, one of the things we realized, if there's one time that the Fed's going to step in, it's when the Treasury market's not functioning well, or if the repo, the repo market's not functioning well in this particular space. So in all honesty, I think the bigger lesson might actually be the opposite. If there's one area where spreads are going to might be volatile, for a few days here and there, but where regulators are not going to allow that type of volatility to persist for an extended period of time, like this is going to be it.
Great. Actually, just in that connection, Darrell Duffy has suggested that studies be conducted to determine whether it would be appropriate to introduce central clearing for repos. And I suspect that if that were to be the case, that some of the volatility issues would also go away. But maybe you disagree, David.
Well, a substantial amount of repos already centrally cleared. Roughly half of the bilateral repo market is cleared, and a tiny segment of the tri-party. I don't know that central clearing would have helped, particularly in March. If everyone's trying to sell, clearing maybe won't net that. So probably my own opinion is March might have happened anyway. Mm-hmm. But I think I am personally a fan of, central clearing and bringing more of the repo market into central clearing. Would certainly allow a wider base to calculate SOFR off of, because we only have the cleared data in the bilateral market. Tom, one of his other hats was for many years, decades, head of the TMPG, and they had certainly argued that there are some operational challenges that greater central clearing in the cash market could address.
Yeah, we definitely, when we looked at this, I've been fortunate to work on the original GSCC, now FICC's cash clearing when that was put in place way back in the 80s, and then repo clearing, and the benefits are just exponential. And I think so more and more, if a side benefit of that compared to all the other benefits of central clearing for treasuries and repo would be a greater data set for SOFR, that would be icing on the cake. But I just think the main point would be that there's great benefits to central clearing in treasuries and repos.
Great. Okay. It seems from the discussions I've heard about that the institutions that are most worried about how they're going to hedge bank funding risk in a world where SOFR dominates, that usually it's small and medium-sized banks more than the largest institutions. Is that an accurate perception? And if so, how do you think they should go about it? Will they be using vehicles like a Maribor as a substitute for a credit-linked funding rate?
So there are definitely some big banks that would like a rate like LIBOR. I won't name names, but there's some big banks that would like it. Small bank, there's an interesting dynamic here. One is, what is bank funding? And that's that cost of funding, that's pretty hard. Is it LIBOR when, that's like 3% of their overall funding, and most days they don't fund in that market? Maybe it's not, right? And, you see this, you saw in the last financial crisis, right? Where, yes, LIBOR went up, but no bank was funding themselves at LIBOR. Mervyn King describes it as a rate that banks don't fund themselves at. They're funding overnight. which was way lower cost. They're funding themselves through massive inflows of deposits. So, what is that? What is that funding cost? What does does a bank need to hedge? And you see it again in March and April, where again, they didn't fund themselves 3 months. They funded themselves overnight, and there was well over $1 trillion of core deposits that flowed into the financial system, and they weren't paying LIBOR on that. So their overall costs actually went down, and so the hedging problem is really quite complicated. Obviously, there have been some regional banks that have written a letter to the Fed, and it is a concern for them. And as to how they can hedge it, there are different vehicles. I mean, we're not trying to impose SOFR as, one rate to rule them all, right? No one's trying to say that everyone has to use that. So they have options available to them. They can do bank CDS. They could, there's different rates that may come out over time. But how you hedge really depends on your funding model. A lot of those regional banks have very large deposit rates, bases. They may not particularly fund themselves a lot wholesale unsecured. I mean, LIBOR was, after all, supposed to represent funding costs of large international global banks, not US regional banks. So it really depends on their funding model and what they can do. In terms of Ameribor, for smaller banks, I think there are a lot of smaller banks who find that attractive because they understand that they may fund in the AFX through the AFX exchange directly. It actually, however, overnight Ameribor, it's like 5 basis points higher than Fed funds, but it moves with Fed funds. So the reality is that a 30-day average Ameribor moves really closely with 30-day average SOFR. So if even someone who's using an Ameribor for loans, they might find that it's more convenient for them to hedge with SOFR at the end of the day if there's something they need to hedge. So I think it's a very interesting problem, and there's probably no one size that fits every bank.
Great. Anybody else want to jump in? Okay. So how does the progress in the United States compare with the progress in other jurisdictions? I mean, in the UK had the advantage of having SONIA for many years, long before we even started thinking about SOFR or creating it. Is the UK sort of the odd man out? Are there other countries that are very far along? Are there others? Are there some that are way behind? And does it matter? Should we be worried about that?
I think that more and more we're seeing that the comparison really is the size of the IBOR and where they are on the spectrum. So I certainly think the UK has moved ahead in a lot of ways, and I think that there's a lot of clarity on where that's going. Obviously, dollar LIBOR is crosses into a lot more jurisdictions, and the size is significantly more. So I think that each of the 5 kind of currency groups, along with everyone else that's doing this work, is moving at a pace that I think is relative to the series of challenges they have, what the market is. And I think, if you look at Europe, where your LIBOR is very deep into their mortgage market. If you look at where Switzerland is, which is basically done and completed their work. So you can work through all of these, in Japan with a 2-rate model. I think that there's that these groups, but we do speak, and I think everyone is moving down parallel tracks, but there's a genuine respect for where their LIBORs or IBORs are, what products they're in, who they impact, what their timelines are. But I think if you just sort of if you put a curve on it about the size of the challenge and the number of products, I think everybody's kind of moving along at a pretty reasonable pace and a thoughtful pace for where they want to get to. And I think if you look at certainly the 5 big currencies, you'll see that the models aren't that far apart. As David mentioned, whether it be SONIA, be unsecured, SOFR secured, everyone is sort of moving at the same pace based on what they're able to do. So, I think we all look to each other for best practices. We all see what worked somewhere and try to leverage those things. But, there's pretty good, I think, good coordination, but everyone's got a whole different set of issues that they're dealing with. So I think, you go through them all, you'll find that I'd say there's a pretty good consistent degree of progress on this. Obviously, Europe did move it back, but they've also converted their CCPs and their short-dated stuff into ester their rates. So there's a variety of challenges, but I'd say fairly consistent progress around the 5 big currencies.
So in Kate's introduction, you mentioned the the idea of synthetic LIBOR as a topic that the FCA is considering. Does that, even discussing the idea of synthetic LIBOR, does that diminish the credibility of the promise to end LIBOR at the end of next year?
Well, first of all, let me make clear there's not a promise to end LIBOR next year. What the official sector has always said is that that's the point at which the UK FCA will not compel banks to submit. So that's the first date upon which LIBOR could stop. And so there's no promise that that's the date it's going to stop for any given LIBOR. But just try to be a clear message that you need to be prepared because it could stop as early as that. So that's important just to be clear about that. I don't personally, Tom can reply. I don't think it calls into credibility those statements because it's obviously synthetic LIBOR is obviously not LIBOR, and in fact it would be SONIA plus a fixed spread, and everyone can see that. So I think people understand it as a way to address legacy contracts in a way that within the UK system could work really well because this is be under UK law, and if under UK law LIBOR is now SONIA plus a spread, then you try to sue in the UK court, and UK courts can say, well, that's what LIBOR is now. So it could work well, and it could help to address what they call tough legacy contracts. Does it help here in the US? Well, Kate can say more, but it's not LIBOR, and FCA will have declared it to be no longer representative. So would it stop someone here suing in the US court? Almost surely not. Would it help? In terms of what the judge might find, it might, but there still would be a lot of lawsuits in that. And so the ARC's perspective has been that if you want to address all the legal risks here in the US, then the best way to do that clearly is some form of US legislation, whether that be in New York or federal. And that's the only thing that can really address the threat of lawsuits.
So I think we have time to ask each of you one more question, which is essentially looking out a year over the next year, what do you see as the greatest risk to a smooth transition at this stage? Everybody gets to answer that one. Tom, you want to go first?
Yeah, sure. I think what we see as the key risks are, parts of the market that have not really gotten there. I think obviously the loan market is a huge market, and I think the idea of some of these challenges. But one of the risks we've tried to highlight a bit is this concept of operational risk, and I think David touched on this a little bit. But how many protocols with how many counterparties are we all prepared to address and deal with valuations at the end of LIBOR? How many loan amendments are we able to handle at the end of LIBOR? How many operational events can we actually all begin to process? Kate touched on the securitization market. How do we deal with all of these things at the same time? And I think one of the biggest incentives in de-risking that will be first people just getting an awareness of that and understanding their own capacity for how many conversations you plan on having the day LIBOR stops, and with who and how are they. And I think, the idea of talking about doing these things well in advance, borrowers, lenders, issuers, investors, reduces that risk. Because I think as someone mentioned, I think it was Kate, that having these discussions when the outcome is that you may have to pay prime for a couple of coupons, a very different discussion than having it now when the determination on winners and losers may be a little bit less clear. So I think that what we're looking at here now is the biggest risk right now is people not paying enough attention to their own operational capacity to prosecute fallbacks and protocols and amendments.
Great. Kate?
Sure. I'm going to cheat and do two. So first of all, when I look at the most likely risk, I agree with Tom. I think the operational challenges of this transition are huge, and they could actually end up being, significant. They're manageable, but they could be significant. So that would be the first one. But if you ask the biggest, everything is set up for the ISDA protocol to go forward for parties to adopt it. And so I think I always thought okay, that looks like what should go forward, but it hasn't happened yet. And you said the next year, if that process starts to fall apart, I would get scared.
Okay. David, you got the last word.
Yeah, I mean, the operational challenges are there. I think this is sort of the equivalent of 5 Y2Ks, but it's different in the sense of, Y2K, you had to actually wait till Y2K, whereas if you want to close out a LIBOR position, you could do that. For me, the risk is, I think the Swiss case points this out, right? You give the Swiss a deadline or a timeline, and they're going to hit that mark, right? I mean, their trains will always run on time. And so if you tell them it's 2021, they will hit it, and they are. And it's a really great example of that building go up amazingly fast. Here, I worry that there are people still, I know there are people still waiting, will there be a term rate, or will there be some other rate? Whereas my own perspective is, the way you address this is you just pick a path and you just go down the path. There's no standing there wondering which path you're going to go down. It's never made sense to me in this particular venture. So that to me is the greatest risk, that people will just still remain frozen and indecisive about what they're going to do.
Great. Well, first, I hope the audience will join me in thanking our distinguished panelists for this excellent session. In about 2 weeks, we expect to post a video of the program on the center's website. We also hope to see you in the audience again at 2 upcoming center events. On October 15, we'll hold a fireside chat with Neil Kashkari, the president of the Federal Reserve Bank of Minneapolis. And on October 27, we'll chat with Geeta Gopinath, the director of IMF Research. So once again, thank you very much to the panelists for your excellent contributions, and thanks to the audience for joining us today.
Thank you.
Thank you.